Hey, well, how's it going?
Morning. Oh, morning. Afternoon. Actually, late afternoon, 6 p.m. We are here for the stock and dissecting stock flow webinar. Is that correct, Dima?
Yep. We'll talk
All
about
right.
stock today.
Yep. So we got a bunch of people who pre-registered on Zoom. We are live on Zoom, which then links us to our YouTube channel. For those who are joining us for the first time, we have a very rich YouTube channel. I recommend you subscribe to it when you get a chance. Let me know where you're from in the chat if you're on the Zoom. We use the chat and the Q&A to ask Dimitri questions as we're going through this webinar. If you're on the YouTube Live, which runs at a little bit of a stag, a little late, just put your questions in the chat and I will try to go back in time and ask them to Dimitri. With that, my name is Will McBride. I am Dimitri's partner and co-founder of Market Chameleon, and I am from Bucks County, Pennsylvania. First, let us know where you're from. We have someone from Boise, Idaho, and it's not Jen, our favorite realtor from Boise, which is kind of cool. And Dimitri, who's to my right on my screen, maybe to everyone's left, I'm not sure how that's working, is from Philly, right, D?
Yep, Philly, Center City.
Love that city of brotherly love. And with that, should we start with the disclaimer? What do you think, D?
Yeah, let's start with the disclaimer, and thanks everyone for joining us this evening. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions, provide you with guidance. There's this disclaimer, everyone.
Perfect.
And I think we could get started. Let me share my screen really quickly.
We have Wayne from Los Angeles, someone from Dallas, Texas, someone from Corona, California. People
Awesome.
Joining from all over, D.
Everywhere. That's great.
Yeah, it's
that's
excellent.
Great. Thank you. So usually we do something on options. Today I'm going to kind of just focus on stocks. And really, it's kind of just to understand some of the things that are going on the tape, because people usually look at stocks as just like volume and price, but there's lots of other things that are going on, important to know if you're trading. And this is what I wanted to cover today. Mention VWAP, what it is. I get questions about that, why that's important. We'll take a look at an example. What is a sweep order? Why do people use them? Also, odd lots. I want to mention those and what's kind of going on with odd lot trades, dark pools, and market on close orders. So I'm going to try to cover all those, take any questions, along the way. So stop me if you have questions, Will, regarding these. I'm going to try to answer them as we go along.
I will, D.
So I'm going to take a look. First, I'm just going to describe what a VWAP is, and then I'm going to go on the Market Chameleon and show you where to find it. But that's a volume weighted average price. And a lot of people, they'll look at a price of a stock, and here's an example: 100 shares traded for $101. Let's say, any stock, XYZ. And right before that, let's say 5,000 shares traded at 120 cents. And let's just, for simplicity purposes, say those are the only two trades so far today. Well, unless you know where the stock is going and you're in a rush to buy it, like if it's going, if you think it's going to like 110 really quickly and you want to pay whatever, you're trying to get a good price, right? You want a good execution relative to where the market is. And since 5,000 shares traded at 120 cents and you get this like one pop at a 101, maybe that 101 is a little bit high. Maybe you want to cool down and see like where the market really is and put your limit orders in, because you still want a good execution. You don't want to overpay, and you kind of want to get a sense of where is the market. And that's why the market typically looks at volume weighted average price and VWAPs. And you'll hear VWAPs, especially in professional circles, brokers, they'll refer to VWAPs all the time. So what is a VWAP? So here in this example, we'll take the first trade, 5,000 shares traded at $100.20. So if we take 5,000 times 120 cents, plus we see another trade, 100 shares times the price it traded at 101, and then we sum that up, we divide that by the total number of shares that traded, 5,100, then really we get a VWAP of $100.22. And that's what a volume weighted average price is. I'm going to show you really quickly where to find that on the, wait, did I, how do I exit? Hold on a second. I'm going to exit here. I'm just going to go here on Apple. All right, so when you type up a symbol here, like Apple, I came up to Apple, here you have the VWAP. I'm on the trading hours right now. And this is today's VWAP. Today's VWAP, $135.76. This is the amount of shares traded, number of trades. This is the standard.
Just an FYI, I'm not seeing that screen for some reason.
Really?
If you're trying to show something.
Okay. Let me see if, did I stop sharing my screen? Let's try it again. Do you see it?
I see. Yep, there it goes. Sorry about that.
No problem. So here I'm on Apple. Just pick the symbol. I come down here to the VWAP. I'm on trading hours, and here are the VWAP stats here. So here, this is the day's VWAP, $135.76. This is the total volume. This is the standard deviation, how much a minute to minute. So what today's standard deviation for minute to minute. This is how far the current price is from the VWAP. Okay, VWAPs are very important. I'm going to kind of get into when I start going into dark pools, explain them a little bit more. But institutional trades, you'll hear them, VWAP me into this stock. I need to buy a million shares, VWAP me into it. So when you're talking about like Goldman Sachs and like Capital and stuff, they're handling VWAP orders for larger institutions. The reason is an institution that needs to buy 1 million shares or 2 million shares, they're not going to go to the market because they're just going to move the price way up, right? So they need to basically follow some kind of a benchmark and throughout the day buy shares to accumulate whatever they need. And they follow basically a VWAP. So they'll follow this VWAP throughout the day. But when we get into the dark pools, I'll show you a little bit more what I mean. Here, you just have minute-to-minute VWAPs. So this is for each minute, 343, this was the minute VWAP. 342, this was the minute VWAP. So for each minute, you get a VWAP, the number of trades, and the volume. Okay, so that's in the minute-to-minute VWAP. And then we're going to talk about these odd lot, sweep, dark pools, and block trades. But hopefully people understand what a VWAP is. So that's the first thing, just to understand what that means. And let me know if you have questions, Will.
I will, buddy.
Okay. So let me come back to this. Since we talked about VWAP, if you guys are okay with it, I'm going to talk more about it when we get to the dark pools, but let's come down to sweep orders. So what a sweep order is a certain order type that some people need to use who are more aggressive and they need to buy or sell a larger amount of stock and they don't want to miss the price. So when we talk about the market and the quotes, we have what's called like trade through protection, right? So when you see a quote out there, like the best bid, best offer, your broker can't trade through it. So if the best offer is like, say, $101, right, and you want to buy it, your broker can't give you a fill of 102. They have to fill you at the best available offer. So you get this like, trade through protection. You can't trade through a market. But there are always exceptions, right? So this is a sweep order. This one is an exception. I'll explain to you. Let's say you're trying to buy a stock, and this is what it looks like on the different exchanges. So NASDAQ, let's say, So NASDAQ is offering, let me do it with a pointer, it's easier. So let's say NASDAQ, there's 100 shares offered for sale for $101, right? Before you do anything, you're looking at this. On the American Stock Exchange, there's 2,000 shares offered for sale, but they want 110 cents. New York Stock Exchange, they have 2,500 shares for sale, but their asking price is 115 cents. So you can see they're all higher. And then let's say the BATS Exchange has 5,000 shares for sale, and they want $101.25. According to the rules right now, if you went to the market and said, buy me whatever, 9,000 shares, 10,000 shares, whatever, the first thing they have to do is buy this for 101. If there's nothing else for sale, if this is the next offer, best offer, 101.10, they have to go to the Amex, buy it for 101.10. This disappears, then they have to go to NYC, buy it for 101.15. And then they'd have to go, if all this disappears, they have to go to the BATS 101.25. So these are all routing to different exchanges. So anything could happen. Things are happening fast, a lot of orders coming in. And let's say you're like, you know what? I think this is worth $102. I need 10,000 shares. I don't want to chase it. I'm willing to pay 101.25 for all my shares, right? So, all my 9,000, whatever this is. I don't care about going to NASDAQ first, because by the time I get this at 101, and then you got to route my other one to here, and then you got to route it to here, these will start disappearing because anything could happen. This could trade, this could get canceled, this could move.
Well, not only that, but they're dealing with algorithms who are trying to spot these trades, right?
Right.
Trying to front run them.
Yeah. So you're dealing with a lot of stuff here. So what happens is you could say, I want to sweep the top of the book on all four of these, right? So and what this is saying is, I don't care if I have to pay 101.25 before even this 101 leaves. Okay, I will pay 101.25. I'll pay 101.15 because I don't want to miss this 5,000. Because if this 5,000 disappears, I might have to pay a lot higher. So you put in what's called a sweep order. Sweep orders, that means, okay, you're bypassing. That's the exception. You're bypassing the trade through rule. You don't care about that protection. You're going to go and buy all of these simultaneously. So it just goes to all the exchanges. It says it's a sweep order, intermarket sweep, and boom. So sometimes you'll see trade through, right? You'll see like, well, how come I saw the price traded at 101.25 when this was at 101? That's because it was an intermarket sweep order, and it's aggressive order. It's somebody who just wants to buy it. They're not sensitive to this, getting a penny here, a penny. They're willing to even miss this 101 as long as they get their liquidity. They're looking for the shares, the size. All right. So I'll show you in the options what it looks like.
We did have a question. Unfortunately, I didn't catch it in time, so I'm not exactly sure, but maybe his question will indicate where you were.
Yeah.
And he's saying, how does that differ from the VWAP indicator? I don't recall you talking about a VWAP indicator, but maybe it was something you were looking at.
So the VWAP is not an it's a volume weighted average price. It's just letting you know where the price is based on the volume traded, right? So it's not like, I don't think it's an indicator. It's more like a benchmark price.
There you go.
Right? So that's what the VWAP is. It's a way. Now I'll explain to you how it's used, because it is used by institutions to basically they peg against the VWAP, right? So they're using the VWAP as a peg. But let's first.
Now, actually, Wayne, this is more of an idea than a question. He's just saying it would be interesting to have a VWAP indicator for options. Is that even a possibility with the amount of data out there to create?
Not really. Well, not really a VWAP. It would be maybe something else, maybe volume weighted average implied volatility things to trade at, but not because the price in an option it's a derivative, so it's moving with the stock right? So what it's the relative premium you're paying for that option. So volume weighted, we have VWAPs on the option, but it's not as good indicator as as what it is for stock. For stock, there are actually algorithms out there, a lot of algorithms that are pegged to VWAP.
Trying to get executed at the VWAP.
At the VWAP, right. So those are actual order types that are big institutional order types that are pegged to the VWAP, and that's why it's important to follow that VWAP. Like professionals you'll constantly hear, VWAP me into this stock. So let's look at and here I'm gonna show a sweep order, and then I'll show you something about the VWAP. I'm gonna stop this. Well, you know what? Am I still? Do you still see my screen? Did I stop sharing?
It's just two beautiful faces, one being yours and one being mine on the screen.
All right. I don't know why I keep pressing one sec. So let's look at an intermarket sweep, right? I'm going to do it in an option. It's easier to do.
There you go.
Find an option. So here, this is the option block trade screener. And let's do a trade condition here, intermarket sweep. All right. And I'm going to, just to make it easier, I'm going to put the trade price, or wait up, is there, trade price. Why is this not working for me? Is above the ask. So here's what an intermarket sweep looks like. Here in Apple, December 31st call, he bought 122 contracts for $2.16. The market at the time, $2.12, $2.15. So you could see 216 is above the ask, right? Intermarket sweep. He bought it on the NASDAQ. It looks like right around the same time. See these three? He bought 86 shares for $2.15 above the ask price. Intermarket sweep on the CBO2. At the same time, see all three exchanges. He bought 101 contracts for $2.15 above the ask on the NASDAQ intermarket sweep. So does everybody see that? The price traded above the market. And that's because you could do that with an intermarket sweep. Same thing with a stock order. Let me know if you have questions. Let me see. I could probably show it to you in a stock. Hold on a second. Let me see if I could do it in a stock or block trades. Let me see if I have that trade condition here. Your sweep. So here are sweep orders in the stock. See, these are after hours. So here's the price, 61.28. He got it 61. So you can get the offer. You don't necessarily have to pay above it, but you're willing to. So these are the sweep orders, and these are in after hours already trading. So, but in the options, you kind of saw that price versus the market. It was trading through. You could do that in intermarket sweep, and it's important to know because that's where knowing the order types, what's going on, why, it gives you a better picture, full insight, what might be transpiring. So if everybody's okay with the sweep orders.
Yep, it's good.
Yeah, and by the way, I'm going to come back to Apple. This one was in Apple. In that VWAP, on that VWAP page, during the trading hours, we're talking about during the trading hours, it went to after hours. Here are the sweep orders today for Apple. There's 179,000 sweep orders, 19 million total shares. So today, that represented 19.2% of the total volume. Based on a 20-day average, usually 23% of the volume is sweep orders. So you could see it's a little bit less, not as aggressive. as a percentage of volume today. But on average, there's 17 million shares that are used for sweep orders versus 19 million today. And if you just wanted to see the sweep trades, you could come down here. These are the sweep trades, the volumes. So if you wanted to see the most aggressive ones, you could just sort like this. So we see, 9:41 a.m. That was the biggest sweep, 6,533 trades, volume of 791,000. And you see that was the VWAP, 134.98, and it was on an uptick. So what this is saying is that VWAP traded higher than the previous VWAP. So the aggressive orders were on an uptick. Okay, there's another one. Second one was at 359 right near the close. This is the VWAP price, and that was unchanged. So if you were just looking to see the most aggressive VWAPs on a day or the amount of trades, these are based on number of trades. This is total volume. All right, does that make sense?
Yeah, people? Very much so. Very cool.
Okay, so that's how you could to look at really quickly at the sweep orders. Let me come back here, do the presentation. If everybody's okay with the sweep orders, if there are no questions, I'll move on.
I think you're good.
All right. So what are the dark pools? The dark pools are, before we get into the dark pools, let me tell you why they even exist. Like what was how they were created. At one point, that the stock exchanges were member owned. Okay, so they weren't like these publicly owned companies like they are today. They were membership owned, and what happened was that all the orders went through a specialist. Okay, the specialist had a book, and the book contained all the big institutional orders, and he would handle those orders on behalf of the institution. So here's what it would kind of look like, and then I'll explain to you why there are dark pools now. So this would be a book. So let's say there's, whatever the stock is, IBM. There's 100,000 shares with intent to buy for $101.22, $101.22. Below that, there's another 950,000 shares to buy for 101. All right, the institutions, they knew the specialists at this point. They gave them the orders to work that order for them. On the sell side, the specialist has this on a book: 200,000 to sell at 102, another 100,000 to sell at 103. So this is what the specialist sees. You don't see it. So one of the things about the specialist is that he cannot front run any orders. He has specific rules in place. So if he sees a big order, he can't just scoop this up and run the book. That's illegal, right? He would get fined and never be allowed to trade. But the book is helping him because it's price discovery. So having those institutions put those orders on the book is helping him. So if $101.22 is his best bid, 102 is his best offer on these big lots, what he can do is improve the bid and the offer. So knowing this, it helps him with price discovery. So he's like, okay, the stock based on my book is worth somewhere between 101.22 and 102 at this point. So he might say, I'm willing to pay, 101.30 cents and sell this at 101.75 cents, let's say, right? So he comes in and says, I'll buy 5,000 shares for 101.30, sell 1,000 shares 101.75. So the small lots he tries to manage himself in his account, maybe accumulate some. He can accumulate because he sees the book is thicker on the buy side than the sell side. So he might, put more in inventory on his buy side with anticipation of it going up. But as long as he's improving the market, that was fine. Now, of course, if somebody came in and said, hey, where can I buy 250,000 shares or whatever, then he'll say, okay, you got to pay like 102 and I'll sell you another 50,000, 102.50 or something like that. But that's how he managed his book. So what happened? The exchanges they demutualized, right? When they demutualized, they went public. And when they went public, they became for profit. They were nonprofit before they became profitable. And when the exchanges became profitable, they took a look at this and said, well, wait a minute. Nobody sees this except for the specialists. But this is a moneymaker because people will pay us to see the depth of book. So they went to the SEC and said, well, we want to be able to sell proprietary feed. That's what they call proprietary feeds. That means you can't get it on the public feeds. You have to go to New York Stock Exchange, buy their proprietary feed. You got to go to NASDAQ, buy their proprietary feed, because nobody sees this. It's hidden, right?
Now, is this referred to as level 2?
So no, it's not level 2. So level 2 will show you the top of book of each exchange.
All right.
But this is actually depth of book. Depth of book will show you the depth of each exchange. So level 2 will just say this is the best bid on the SIBO. This is the best bid on NYSE. That's all you get is the top of the book. This is depth of book, which saying you see all the levels on each exchange. Okay, so you get a much clearer picture. So now it's kind of like playing cards, playing poker, but you see the other person's cards. They don't see yours. Does that make sense?
Yeah, I can only imagine the expense of that.
Right. So what happened when this occurred? So the exchanges, New York Stock Exchange, NASDAQ, all the exchanges that demutualized, they said, well, people will pay us like $50,000, $100,000 a month for these fees, right? So we want to, but they had to go to the SEC, get this approved. The SEC said, okay, you could sell proprietary fees, right? You could sell this is your whatever excuse they said. People are putting it. These are your fees. You could sell them as long as there's like a public feed that shows the best. But the people who are buying these proprietary feeds are not specialists. So they don't have the same rules as a specialist. In other words, they're allowed to front run the book.
So
okay? High frequency traders are allowed to front run the book.
That was actually a question Wayne was asking. He's asking, what's the difference between your example and front running?
So a specialist or market maker is not allowed to front run. Okay.
Gotcha.
He's not. So let's say you could improve the book, right? You could create liquidity. You can improve the book, but you cannot turn around and take out a limit order to run up the stock. Okay. That
if you know an order's coming in, you can't take out the offer just to get.
You cannot take out. Order. So let's just say, let's say the specialist knows, hey, I have 1 million shares to buy. A specialist cannot turn around and buy the shares on his book, front running that order. That's illegal. You get, and they monitor that, so you cannot do that trade, right? So that's very, strictly monitored. Market makers, specialists, you're not allowed to do that, and they will catch you right away anyway because they see the order, they see what orders you're doing. But that's as a member of an exchange. If you're not a member of an exchange, if you don't have specialist or market maker status, you could do whatever you want, right? So you're paying NYSE for their depth of book, you're paying NASDAQ their depth of book. All of a sudden, you have a very clear picture of the order book imbalance, right? So now you see the order book imbalance. Remember, this is before dark pools. So then it's up to you to figure out what you want to do with it. In the beginning, it was very easy because you're like, okay, well, I have, the VWAP here, 950,000 times 101, 101 to 100,000. So I got, over 1 million shares indicated to buy, 300,000 shares indicated to sell. If I buy this 200,000 shares, what will these guys do, right? They step up and you just keep walking them until you find an equilibrium, right? That was very easy. What happens? Most of these orders are stepping up based on the VWAP. So if you're plucking away at 102, you buy 1,000 shares, right? The VWAP goes up, he ticks up. You buy another 1,000 shares, he ticks up. So every time you're making the VWAP go up, this order is automatically just moving up with the VWAP, right? So remember, you're buying 102, buying 102, buying 102. The VWAP goes up. This is adjusting from 101. It'll go to 101.30, 101.40. So they see that. Once you clear this out, the next, you see that air bubble is 103. And that's what they're doing, just walking up the order flow. I'm giving you a simplified version of it, but this is how it started with the high frequency traders, because they saw all the institutional orders and they knew how the institutional orders worked, right? Most of them already worked for Goldman, Knight, whatever. They just went out, Citadel. So they already knew how the order flow worked. They just needed to see it. So of course, this was going on for years until the institutions were like, well, wait a minute, this doesn't work for us, because what they were used to, all of a sudden, it was working against them, because when, the high frequency traders, they didn't care, they could front run. The high frequency traders just said, well, these are our predictive models. If we see, your SEC told us we could use the depth of order book, right, to create our predictive models. And we predict that if there's 1 million shares to buy here and only 200,000 shares to buy here, the market's going to go up, and we bought it. That's it. And that's how it went. And the SEC, okay. So they just said our predictive model said it's going up, so that's why we bought it. These institutions, though, then they started wising up. They're like, well, we're getting terrible fills. This is costing us a ton of money, and their returns were going, the mutual funds, all these their returns were going down. People were going to pull money out. So they went back to the specialists, who were Goldman and Citadel, and they said, well, you guys were specialists. Like, what do you guys think? How do we get this protection? So they said, let's create these dark pools where you cannot see. We're going to hide these in the dark pool. So they went to the SEC, right? And they told them, like, these people are not happy. Like, you're putting in an order, you want to buy 1 million shares, and the stock runs up on you, $2 or $3, and then they slam you and the stock comes back. So the SEC said, okay, you could create these dark pools where the orders are off the exchange, they're not lit. Whoever's running the dark pool, like say Knight Capital, Citadel, or Goldman Sachs, whoever's running the dark pool will hide this order. The only thing they have to show is when a trade occurs. So they're not going to show, in a dark pool, you don't see the intent, you just see when a trade happens. All right, so this would be still invisible. And of course, for the dark pool operators, this is important because, if you're Goldman and you're JP Morgan or your whatever, Knight Capital, you want this information, right? Because you don't want to front run them, but that information is important to you, because now you have information that helps you with price discovery, right? And they didn't want to give that up, and they didn't want to give up their customers who they're making commissions off. So they created these dark pools. So far, does everything make sense that I said? If there's any questions, well, let me know.
All right, well, let us know. I mean, the chat's a little delayed on YouTube, so anyone on Zoom, is this making sense to you? Any questions? We did have a question I missed. Shata was asking, and it was when you were on the VWAP data. She's saying, what is the use of this data after the fact? Would it be most useful while happening? But we are showing the VWAP while it's happening. But that's what she's asking. Yeah. Would it be most useful while it's happening to base our decisions? But, no one's going to front run this data, right? Who's using the Chameleon. Yeah. This isn't for high frequency trading.
A VWAP is just, it's like a benchmark that you're looking at. Instead of a price, it's a benchmark, right? It's not an indicator of what's going to happen. VWAP by definition already happened, right? For you to get the prices, the volume had to trade for you to create a VWAP, right? So it's a benchmark of what transpired, so you have a sense of where the thickest trading is, the prices, and the volatility around that VWAP. Okay, so that's what you're looking at, where the price has been trading the most, the thickest, and you want to know how much variability around that VWAP. Okay, is it moving too far away? And if it and how it's moving, but that's part of the VWAP analysis.
Raj is asking, how would a options trader potentially take advantage of this? Any ideas?
Of a what, like a
Yeah, well, it could be. I'm assuming more like the block trades that are like the sweep orders. I mean, I think you showed in Apple. I mean, if you see over a series of days that they're, the number of sweep orders are going up and the stock's moving higher each day, you could form an opinion on it, right? Which then you could take to the options market if you want.
Yeah, you'd have to kind of like just take into consideration other things that are going on. No one thing. You would have to put pieces together to see what you think is going on, right? Do you think today's activity is different from previous days, and is it indicating like maybe that there's a new buyer in place, right? Or there's somebody in the dark pool, or there's a lot of intermarket sweep orders coming in. So you would try to kind of, for yourself, paint a picture of what's different today than previous days.
Yeah, cool.
So with the dark pools, again, let me see if I could exit. I'll get to let me finish the odd lots, and then I'm going to go to the dark pools, and I might as well talk on market orders. So odd lots are shares that are less than 100. So 100 shares is a round lot. So if you buy 1 share, 2 shares, 3 shares, that's called an odd lot. And the rules might be changing a little bit around them with higher price stocks. But in general, specialist market makers did not want to deal with 1 share, 2 shares. They didn't want to keep them in inventory. So really the rules are made that odd lots would be treated differently than round lots of 100 shares. So what does that mean? An odd lot doesn't set the last price. So when you see a last price, right, like say, whatever, G traded at $11. Well, that was a result of a round lot. If G traded 1 share at $11.15, it would not show up. It wouldn't print. You wouldn't see that. It just kind of like it happened, but it doesn't go on the public tape. So on the public tape, it doesn't set the last price. You could see it, but it's not an official last price. So that's number one. Odd lots also don't have the same trade protection rule as a round lot. So if you go out there, and the reason is that the markets could be moving very fast. And when the markets are moving very fast, you have to clear everybody's prices before you can move the markets. So they don't want 1 share to hold up the markets. In other words, it's just discarded, right? You could trade a 1 lot, 50 cents through the market, and it doesn't have a trade protection rule. Usually they'll probably get it at the market, but they don't have to. Okay, so you don't have that same trade protection rule, and it's not displayed. So when you do 1 share or 2 shares, right, and you put it in between the market, it's not going to display. Nobody's going to see it. It's there because it doesn't officially get displayed. So those are things to know about odd lots. And now we're seeing a lot more odd lots actually trading, especially as these prices get higher, like Tesla and Amazon. And I'm not sure how they treat those odd lots, because I think with the higher price stocks, they are starting to change the rules. You have to check. But in general, that's what you have to think about odd lots. And some people just made money, I remember, with odd lots, because if you're scooping up odd lots away from the market and you get enough of them, to add up to 100 shares, you can just flip them out. But that's the thing with the odd lots. Let me go to the next one. Market on close orders. So the market on close orders is the following: that you a market on close is just saying that I want to buy or sell this stock at the market, but the closing price. So I want to buy 5,000 shares, 10,000 shares, 50,000 shares, but I need the closing price. So why is that? Like, why would somebody need to do that? And the reason is, and this was created on purpose, right? Because they had to actually create this order type for a purpose. And the reason is because certain institutions, very big institutions that trade a lot, like mutual funds, actually trade the closing price when they have to create or redeem units, right? Because when they have a bunch of people who want to buy new mutual funds and a bunch of people want to sell it, well, they do it at one price at net asset value based on closing prices, right? So when they have to create and redeem units, they have to do it at the closing price. That's how they calculate their net asset value. So, Fidelity or whatever, get a bunch of people that need to invest in mutual funds. They need to create it, and they don't have enough inside sellers. They have to create new units. They're going to buy this amount of shares at the closing price, market on close price. So do people understand that? Market on close.
Everyone understand market on close? Let us know in the chat. See, you seem good on market on close.
Okay, so let's now, I'm gonna exit here, and we'll take a look at Apple. So here's Apple. Remember, we're talking about the odd lots. So in this odd lots, remember, these volumes are not cumulative. These are because some of these are overlap, like a sweep order could be in the dark pool and a block trade. Odd lots, we don't even count in the VWAP because they don't set the last price. So we take them out of the VWAP price, just because they don't set the last. You could see here, odd lots are usually like retail flow, right? Like people who are just can't afford, the stock, but can buy one share at $135, or two shares at $270. They'll put in odd lots. So those are just kind of giving you an indicator of the potentially retail order flow, right? So today, it's pretty much in line with its 20-day average. Okay, sweep orders we talked about. Dark pools. So this is the dark pool. 58.6% of the stocks that traded today were in a dark pool. Okay, now here's how dark pools. I think one thing I forgot to mention is, so in a dark pool, you have two things going on. One is that they try to match up institutional orders, right? Big orders. But if they can't, what they're doing is taking retail order flow and slowly matching them up with the bigger order flow. Okay, so that's what's going on in those dark pools. So we see here today it was more active than usual in the dark pool, 58.6%. And these are block trades that we didn't talk about. I'm not sure if we have enough time.
So that's a 20-day average, correct?
Yeah. So this is a 20-day average that you could compare it to and see if it's going up or down. And of course, you could just go in there, say, show me the dark pool. Again, if you just want to see what time is the most active, what happened, what prices. All right. Again, it could be, something big that matched up, or it could have just been a lot of trades that matched up with bigger orders. And those dark pool operators usually will try to match up retail order flow with bigger institutional dark orders, right? To try to get them as much as they can. Because remember, like, those institutions want those big orders. They want to see them. They want to know where those institutions are pricing these stocks. So that's happening in the dark pool. Again, if you wanted to see big trades in the dark pool, come back here, big money stock flow. We could go look at the stock trades. All right. These are bigger stock trades that are happening today of either 10,000 shares or more or $200,000 worth of stock or more. And we could take a look at, let's take a look at, not the exchange. Let's look at not after hours, but the main session. And let me see if I have dark pool in here. But I had it. Oh, wait a minute. Trade conditions in here. So dark pool. So here's some dark pool trades here. You see AR at CT. This one traded 5:30. This one's after hours. Hold on. Why is this?
While D's looking to find his dark pool data he wants, remember, everyone, we have a morning show for people who are joining us for the first time every trading morning starting at 9 a.m. I'm sure most of the people on the chat who are active are daily participants in the morning. Also, if you haven't subscribed to the YouTube channel, make sure you subscribe. You're constantly alerted when new videos come out. We're putting them out at least a couple a week, right, D?
Yeah. So I tried to, but here, let me just go back to the and let's just take one out. Let's do Facebook. Right. So here's Facebook dark pool trades, and let's just look at some of the biggest ones in notional value. So here's one right at 406. This traded in Facebook, $95 million worth. This is the amount of shares at $277. 1130, 339, $94 million. This is one trade, $94 million. This one is contingent. So the contingent one actually has a derivative tied to it. Let's say this one, right? This one's not contingent. 1036.40, $26 million worth of stock, 96,000 share block traded at $270.89. So these are the ways, like, just to go in there and filter out what went on in the dark pool as far as like big trades matching up. Okay. Does that make sense?
Yeah, that makes sense to everyone.
Okay. So let's take a look. The last one's a market on close order imbalance.
While you're bringing that up, Raj did ask, is this data available real time? I'm assuming like all the data, because it comes through the same way. It's on the 15-minute delay.
It's on the 15-minute delay. All right. So here, let me show you. Well, here's a market on close order imbalance. This data, it comes out 3:50 p.m. Okay. Again, remember we talked about market on close order imbalance, that when there's an imbalance, right, to either way, and I think this has to be at least 50,000 shares or more to get put on the consolidated tape. When there's an imbalance at 3:50 p.m., it gets printed on the tape that there's, for example, here, there's a sell order imbalance for 126,968 shares. Okay. ADT, here we could look at, let's look at the buy order imbalance. Here's one for 1 million. Philip Morris at 350. It gets printed on the tape, $82.54. $1 million worth they bought. So, and I get this a lot. Like, can I get this real time? Right? Obviously, we're on a 15-minute delay, but what would your first, like, let's see if people think like a trader, because sometimes it's not clear what you should be doing if you were thinking as a trader. So what would be the first impulse? Like, let's just ask, if you were able to see this real time at 3:50, what would you do? Would you do something at 3:50?
Yeah, well, this kind of ties into Ahmed's question. How do you know if this trade is a buyer or seller?
Well, it's a buy.
Every trade is a buyer or seller, right?
Every
I mean,
trade has a buyer and a seller, but this is a buy and balance. But so this one is looking to buy 1 million shares. In total, it's not one person, could be just an aggregate. There's more buy on close than sell on close. So what would people do? Like, just ask. I'm just curious. What would they do would they do anything at 350?
well, D's asking the question at 350. If you knew that there was a buy on close and balance, what would you want to do? Would you get to know the price too?
Well, you just no, because you don't know the closing price, right?
Yes.
It has to be done at the closing price, but you just know that it's 1 million shares to buy at the close. And people say, "Well, I want to do this real time," and I get this all the time. I'm like, "Okay, have you ever even done this?" No, but I just need to know it real time, because as soon as I see it, right, what is the first impulse? I want to buy it at 350. Is that what people would do?
That's what people are saying, that they'd buy it.
Right. So think of it this as a trader. You see a buy order and balance at 350, but you know that it's not going to get executed until 4 o'clock, right? So between 350 and 4 o'clock, it's trading and anything could happen. So why would you buy it at 350 if you know it's going to get executed at 4 o'clock? Really, your lowest risk is buying it right before 4 o'clock and trying to sell it at the close, right? So as a trader, if you're seeing this at 350, but it's anything could happen still, and the order is only going to get executed at 4, really, all you're doing is just taking that risk if you're buying it at 350. But not only that, you guys already have, if you see this, right, PM, here's a buy, and this is why we give the data to do the research, and it's very quick to validate your nobody wants to validate, they just want to do it, like, just forward test it. But at 350 today, there was a buy order and balance. You could go 2 p.m., right? You could just go very easily 2 p.m., go to the VWAP, right? Go to the trading hours and see, here's the price at 350, right? What if I did it at 350, right? What if I did it at 351? What if I did it you could really easily validate, does that work? Nobody does that. That's why we're saying we're giving you the tools to do this research, to validate it, and that's most of what you should be doing is the preparation and the research, right? And I get this almost daily, right? Almost daily. Well, I just want to see this in real time, right? Because as soon as I see it, I'm just going to buy it, right? Instead of actually validating, well, would that even work? So I'm just kind of showing you here, you have the data, you have the tools. What you want to do is prepare and just validate. Like, before you put real money in it, like, what if it worked? Would my idea work?
Fred Wright did say he would sell puts. That was his idea.
Okay. Or in anticipation that the stock, right, at that point.
Yeah, I mean, really, again, like anything, we have to see if there's a pattern, right? And if there's a pattern of these, to me, would be analyzed over time, and then you could maybe do something based on, statistics. If there were buy-in orders and over the next week you ended up seeing something, or the next month, then you could start doing something with the options.
Right. Well, but you start to validate it, right?
Yeah.
What happens the next day? What happens but you have the tools there to do that research. You could easily do it, and that's kind of like what the research is there for. But we're up against 7 o'clock. Do you have any questions about anything that we
well, I don't know. Have you ever heard the term? We had a question about an anchored VWAP. That I have no idea what an anchored VWAP is. I'm not sure if you do, but if you wanted to.
I think it's more like what they're looking here. I'll go to.
It said, could you also comment on the VWAP and anchored VWAP?
So I think what they're referring to is more of this. So I'm coming back to so during trading hours, you could break down the VWAPs to see where the heaviest prices were, right? So in this situation during today's trading, the biggest VWAP, most trade is between $82.33 and $82.45. So you could see by this bar how much more in volume traded around those prices relative to the other prices. So you see up here, kind of it traded up, but not a lot, right? It didn't hold and kind of came here. That's where it held at that big bar right here.
Yeah, well, I did do a quick search, and it looks like some technicians take an anchored VWAP and plot it out for the day. Like they would take, like you're talking, that biggest piece, and
Right.
maybe what the pre-market VWAP, and use that as the anchored VWAP, and then use that
Yeah.
as something to trade around. But
Yeah, so you could do it at the pre-market as well. So here, nothing really traded in the pre-market. There weren't that many trades you could see here. This is not that many trades, so nothing there to see. But yeah, that would be during the trading hours. That's your that's kind of like where the volume was and the prices, where you could see like where the concentration of the prices were relative to the volume.
Excellent job, Dima. What was supposed to be another half-hour webinar, we're butting up on an hour, buddy. Good job.
Yep. So thank you, everybody. I think, if there are no questions, we'll see you guys tomorrow.
I think you're good. Remember, everyone, if you're joining for the first time or you're on the Zoom and you haven't checked us out in the morning, we have a morning show every morning, 9 a.m. on our YouTube channel. If you've never subscribed, subscribe to that channel. Thanks again, Dima. Everyone have a great night, and we'll see you tomorrow morning.
Thanks, everyone.
Peace.
Good night.